Hey, everybody, and welcome back to the Teaching Tax Flow Podcast, episode 152. That's right, 152. We are looking back a little bit deeper into the One Big Beautiful Bill Act, OB3, but this one specifically, what that means for small businesses. So before we get into this one specifically, let's take a brief moment and thank our episode sponsor.
Hi, Chris Picciurro here, founder of Teaching Tax Flow, co-host of the Teaching Tax Flow podcast, and pickleball enthusiast. Yes, if you listen to the podcast, you know almost every episode we talk about pickleball, the most popular and growing sport in America. We have tons of opportunities for paddles and pickleballs, but we don't have a lot of great gear on the market. Well, I'm so excited to announce that Sunsets and Dinks are now a sponsor of the Teaching Tax Flow podcast and produce amazing gear, not only to look at, but you feel confident on the court. Because you are part of the Teaching Tax Flow community, you get a 15% discount on all your orders with them. I know I love the gear I received, and I have quite a good record while wearing it, believe it or not, even at my level. Go to teachingtaxflow.com/pickleball and simply enter TTF15 in the serve up promo code area of your paddle rack.
Alrighty, we are back here again on the Teaching Tax Flow podcast. Here, joined as always by my wonderful co-host. I was going to say one big beautiful co-host, but that is completely not what's happening. You know what? We know you're a beautiful specimen there, Chris Picciurro. What's happening, brother?
Oh, you're going to say one big beautiful bald, and then an A word,
Dude.
OB3. But I guess maybe today you would. I don't know.
Oh, that is amazing. Today,
but that's all right. This always makes my day to do this podcast.
Hey, you know what? That may be the best acronym we could ever come up with on the
yes.
show. So, all right. Well, let's wrap ourselves back into something that not just us thinks are funny. So regarding this act, right? So we're looking at how it relates to small businesses. I'm excited about this one because obviously a lot of our audience, listeners, community members, either they're in business already, they're thinking about it, they're in process of it. For those of you that are listening that are not real estate investors specifically, here's a reality check for you. If you ever do invest in real estate, hey, you're a business owner. Technically have done right, Chris? Or am I wrong in saying that?
It's an investment and right. And in this podcast, when we talk about small business owners, it doesn't necessarily mean your business is small. And really, we like to use the term closely held businesses, meaning it's a small ownership group. It might be one person, it might be a couple family members. Typically under 5 people own the business. So yeah, we have some clients in our private CPA practice that we would call them small business owners, but it's really just a small ownership group. Their business can be big, so closely held business. But yeah, what I think, the IRS, based on some of the rules and when you could be accrual basis versus cash basis, they look at quote unquote small businesses as about $20 million or less of revenue. So that's pretty significant amount of revenue. And the vast majority of businesses are definitely under that revenue amount. So yeah, we're going to jump into OB3. Yeah, you know me, and we've already talked about some real estate, some individual provisions, and the bill was or some people like to call it HR1, but the bill was very friendly to business, as we could expect. It is kind of a extension / cousin of the Tax Cuts and Jobs Act of 2017. So there's some things that are very similar in OB3 than TCJA. John, we're still waiting on your sound effect for the acronym.
Don't worry, they play in my head every time we say them, and I'm trying to think of one that just doesn't. Yeah, we did have cows mooing in one we did way back in the day. So maybe
we'll yes, but the people still want their sound effect.
We'll come up with a good one. Let's see. Hold on. We'll cut it in right there, and right there.
Whenever we use an acronym, that's our new one. So what did OB3 do for business owners? And in no particular order, we're going to highlight the top provisions that are primarily beneficial when you talk about lower tax rates. The first one is going to be the extension of the QBI deduction. That stands for, that's another acronym, right? Qualified Business Income Deduction, or Section 199A. And this deduction, the special deduction, came about during the Tax Cuts and Jobs Act. It was set to expire after 2025. It got permanently extended. And what the QBI does is it allows a taxpayer up to a 20% deduction based on their business income. Now, there are some limitations based on income. There are limitations based on if you are in a SSTB, which stands for Specialized Service Trade or Business. We did talk about that designation with Brady Weller, who was on our QSBS. Oh, not another acronym. If you're an SSTB, you're not eligible to get the QSBS, tax-free capital gain.
You keep dropping all these acronyms, you're gonna become a real PITA.
I know.
PITA in my editing world.
I know. It's gonna be now you just have another acronym. But it's not that's not really a tax acronym.
That one don't count.
So you can get up to a 20% deduction. If you're phased out based on income, you could potentially get a QBI deduction based on the wages your business paid to other people or that you're allocated, or assets. UBIA, I know you love this, unadjusted basis in assets. So the point is, when you think about this deduction, Section 199A deduction / QBI, it's a deduction that's taken on a personal tax return. If you receive K1s, typically, check out our other episode on K1s for dummies. We don't think you're a dummy, but we kind of like that term, that episode. If you receive a K1 from a partnership or an S corporation, there are things on that K1 that are really important that help you take that QBI deduction. And you could have several different businesses that are feeding into that one deduction. So really powerful tool, up to a 20% deduction. We do a lot of tax planning in the private CPA practice, and I know, John, in all seriousness, we've seen a spike in listeners and people in our private Facebook group wanting to do personalized tax planning with us through Teaching Tax. So they're very happy with their tax professional. And they realize tax planning and strategy complements that. So we're doing some one-on-one a la carte work with them. And one of the things is maximizing this qualified business income deduction. So that's probably the biggest news for, I'm going to put that as number 2. That's the number 2 biggest news for business owners. Now, number 1, 100% bonus depreciation is made permanent. Remember, under the Tax Cuts and Jobs Act, bonus depreciation went to 100%. And there was a phase out, meaning it was reduced year by year. And in 2023, bonus depreciation went to 80%. In 2024, 60%. Here in 2025, bonus depreciation is going to be set to 40%. What bonus depreciation is, it is a provision that allows you to deduct the entire amount of asset purchase instead of write it off over 5, 7, or 15 years. And when that went to 40% here in 2025, that significantly decreased the tax benefit of purchasing new equipment, doing cost segregation studies on real estate assets, and now that's back up to 100% for assets placed into service, I believe, after January 19th. So big win for business owners, real estate owners. We are going to see a huge spike in cost segregation studies. We do have a special episode on cost segregation studies in our podcast catalog. And Bertie told me that we might have to revisit that later this year as well.
I think so. And Chris, I'm really happy that you mentioned that 100% bonus depreciation. Not it's made permanent, but not even just that, what it is, right? And for those of you that aren't familiar with that, I think now is probably a pretty good time to, mention, okay, that doesn't mean you go out and buy $500,000 equipment. You take 100% deduction this year and you sell it next year and you're free and clear, right? We don't have to get into depreciation recapture at all.
Right.
But just letting everybody know that is not a free card. Listen to this. You're surprised that I know what that is.
I never thought the depreciation recapture would come from your mouth. So this is impressive.
Can you believe? And it came out so natural, right?
Very
so
confidently.
Yes, I know what that is, because I was one of those people that thought, why can't you just, once it's written off, quote, I'm doing air quotes for anybody that isn't watching this, written off. Oh, well, great, then I can get rid of it and I'm good. I just made all my money back and did all this stuff. It's not that easy. So we won't get into it, but I did want to mention that. if anybody's wheels are turning, then you have not a scapegoat, but a shortcut. Doesn't exist that way. But so I'm glad I made you proud today. Look at that.
It's a proud moment. I think one of the next thing I'm going to talk about for business owners is something that not a lot of people are thinking of right now. I actually think might be the biggest opportunity, no pun intended, with OB3. I'm going to drop another acronym on you just to get your feathers ruffled. QOZF. Oh, what is that? Qualified Opportunity Zone Fund. So OB3 extended and reformed those Qualified Opportunity Zone Fund programs with new compliance requirements and extended exclusion windows for capital gains. So what that means is that if you have any type of capital gain, it doesn't have to be real estate and you have to do the 1031 exchange. We talked about that 1031 exchange in our podcast episode of the OB3 for real estate investors. Any type of capital gain, you could actually defer it using Opportunity Zone funds. And this has not only been extended, but it's been enhanced because it was back when the Tax Cuts and Jobs Act first came out, Opportunity Zone funds were very prominent because of the tax deferral and the step up in basis. So I think this is something that a lot of people are overlooking and we are going to lean into. We are working right now. We are efforting, as they say in our business, in getting a special guest on to specifically talk about Opportunity Zone funds and their tax benefits. So I'm excited about that.
And I look forward to that one too, because that's one that I don't know a whole lot about. I say some things that roll off the tongue easy, but OZ funds, I'm pretty in the dark with those personally. So I look forward to that.
When that's something to consider, yeah, there are a lot of compliance requirements when it comes to, just buying a property in an Opportunity Zone doesn't give you tax deferral. You have to have a qualified Opportunity Zone fund. And we're going to dive into that in a future episode. And but if you have questions, jump into our Defeating Taxes private Facebook group. We're happy to answer them.
And actually, Chris, on that note too, because I know we do have that planned here. I don't have the number in front of me, our tentative date for that, but it's definitely within the next month, I believe. Anybody that's listening to this, send us the questions that you may want answered on that podcast ahead of time. And we'd love to, whoever the guest is on that, we'd love to put them out there. So if you have some questions or you know nothing about it, even tell us that you know nothing about it and you're interested in it would be helpful.
Absolutely. And I feel like we're broken record sometimes, but our people in our community, the Teaching Tax Flow community, the voice of tax planning, by the way, you drive our content, not us. We've got some spreadsheets and some things in the cloud that, it could be, John, I remember I was telling you when I was up in Michigan in July, randomly ran into a friend at a smoothie shop because my daughter was badgering us for a smoothie and having a discussion with her. And it actually led to a whole podcast episode about what to consider when you're changing jobs, which is a very popular podcast.
Absolutely.
So you just don't know where the content's going to come from because the people drive it. What your concerns are as a taxpayer, as a tax professional, drive this content.
Yeah, it's like dad jokes. We can tell dad jokes all day long. We're the only ones that think they're interesting and funny. So if we keep talking about all the topics we think are interesting, that's not what everybody wants. So it's always good to have the community drive.
Absolutely. So the next, and what I called the big provisions with OB3, the next one is another big one. Now we've got some other ones we're going to talk about in a couple minutes, but I call this the fourth of the big four: the SALT tax deduction raise and the PTE workaround. Oh no, now
these
two more acronyms.
They're coming out of left field. We'll put them subtly in these. We don't want to turn this into a Star Wars film.
Right. Remember, one of the 3 laws of teaching tax law: tax agencies are your involuntary business partner. Tax laws are to encourage and discourage certain behavior. So when OB3 was working through the Senate and the House and narrowly passing, they had to put some provisions in that made both sides of the aisle happy. One of those things was increasing the state and local income tax deduction. That's what we call SALT tax deduction. When you itemize your deductions, it was only at $10,000. That increased to up to $40,000 per year when you itemize your deductions. That obviously helped high tax states, we always talk about California, New York, New Jersey, Pennsylvania, Virginia, Michigan, Ohio, Wisconsin, Minnesota. These are states just off the top of my head that tend to have a higher income tax. And so, John, if you live in Michigan and you paid $60,000 of state of Michigan tax, you were only able to deduct $10,000 of that on your federal tax return previously. Now you can deduct, if you're married, up to $40,000. There are some income phase outs there. Step 2, there's something called, there's that second acronym, PTET. Sounds like a medical test, right?
It
They're coming in
does.
for their PTET. Let me get the machine ready.
It really beep, 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 beep.
PTET stands for pass-through entity tax. So what happened was, let's say you're an S corporation shareholder in the state of Michigan. You're paying $60,000 worth of state income tax personally, and you're getting a deduction for only a fraction of that. You could make a pass-through entity tax election, have the S corp pay the state tax on your behalf. Okay, so you're still paying the state tax, but it becomes a federal tax deduction, and you get a deduction for the entire $60,000. So the point is, if you're a business owner and you're paying a significant amount of state and local income tax, that doesn't even include any, like I said, local taxes. Like if you work in the city of Detroit, city of Grand Rapids, in Michigan's case, New York City. Now, between the increased salt caps deduction and the PTET workaround being preserved, because that PTET was, some states adopted it, some states didn't. There was some question as to if the IRS is going to allow it. They said, okay, that's fair, we're going to allow it. This has really helped business owners in these higher income tax states do what I think is personally what I think is fair, allow them to deduct the state tax they're paying on the federal tax return. So those are the big things.
And Chris, on that one specifically, right? I think I would regret if I don't say this, right? So the way you just described that, right? I think is a perfect, like a 5-star review of what tax planning could actually be like, right? Because if somebody's not familiar with something, but then they're also, not familiar with how to truly execute and plan for something like that, you're in I mean, I wouldn't say you're in trouble. You're missing out on opportunities, but you can't get in trouble, right? Because I mean, and I say this personally, I don't think there's any shortage of information on anything on the wonderful, World Wide Web that we have now, right? But I think where a million things, fall short, and that's what everybody who's listening to this is what we try to get around is we very rarely will say something or discuss something and not give a little bit more insight on how to actually see it through, right? And that's obviously we can't do it all because everybody's situation is different. There's no easy tax return, et cetera, et cetera. Right. But the way that you really described that one really stuck with me because you said it, you explained what it is, and, we kind of wrapped it up as like, this is a piece of something and you need to plan for this. There's not a box you check and say, yes, I want to do this.
Yeah, I'm going to get a t-shirt that says ideas are cheap, implementation is valuable. We say it all the time in our private practice, and you nailed it. There is too much information out there. It can confuse people and they don't know what applies to their situation. That's why it's great to have a lot of information, but it's important to work with a tax professional that can apply all the stuff to your situation.
Yeah. I mean, think about it as it relates to everybody now, that has an email address, right? 20 years ago, you got an email, you knew it was for you, like it was not junk mail, it was for you most likely. You read every one of them, right? Now, you maybe read 1 out of 20 emails you get because most of them are junk. Like it's where there's an overabundance of stuff out there.
And again, now your email basically filters out what they think's important, what they think might be important, and what they think's junk.
Exactly.
And then you can make rules, obviously, but absolutely. It's crazy. Well, let's jump back. Let's wrap up here with a couple of the maybe lesser known rules. Maybe they're not lesser known. They're just not going to apply to as many people, but the people they apply to, it's super important. So the first one's going to be the expansion of the FICA tip credit. So if you are in the restaurant business and you know that you get a credit on your tax return for FICA, which are payroll taxes paid to your employees and reported through payroll. Why would an employer get a credit? Tax laws are written to encourage and discourage certain behavior. Gee, because a lot of these tips maybe weren't getting reported. So the government said, look, employer, if you report the tips properly, we're going to give you credit for it. And that's why you see a lot of, in my opinion, see a lot more restaurants basically saying we're cashless. We want everything going through our register. Well, this tip credit expanded to the beauty and service businesses. So obviously with my hairdo, I'm not going to get into the into the salon often, but it was usually limited to food and beverage. Now FICA tip credit now extends to salons, spas, estheticians, and wellness businesses. So John, when you start working on that dad bod, you can the tip you give, yeah, that employer can give a credit, and employers can claim a dollar for dollar credit on FICA taxes they pay on reported tip income. And remember, we have an episode, a long episode, a long time ago. We talked through, and this is important, the difference between a deduction and a tax credit. Tax credits are better in general than tax deductions.
Absolutely.
So if
I
you're in
almost
that
forgot
business,
about that one.
yeah,
That
if
was a
you're in
great
that
show.
business, make sure you report things properly.
Absolutely. And now we think about that too, right? There's a couple of restaurants that we go to in town, our little town here that have gone, they've gone cashless, really. So interesting. And it would make sense why, right? Because you're literally forcing people to adopt to it.
Right.
So makes sense.
So for a couple another one, let's talk through a couple more for employers. So there's an increased dependent care limit. So when you talk about childcare, dependent care, you have two options. You typically can put money in if your employer allows it pre-tax through your pay through your W-2, and you're reimbursed for the daycare you paid, but you're getting it off of your W-2, or you could just pay it out of pocket and take a credit for it. So starting in 2026, employers may now allow workers to contribute. This is a higher limit, up to $7,500 annually pre-tax in the for dependent care, and that used to be only $5,000. And as you know, John, luckily my kids are out of the daycare age.
I want to know where the heck somebody's finding daycare for $7,500 a year.
Well, no, it doesn't say that. Just it's saying that they at least this first $75,000 is pre-tax.
True.
Under a Section 125 plan. So that's pretty good.
That makes sense. Yeah,
Yeah.
these little minions are pricey. Everything helps.
Well, because John, now that those contributions are exempt from federal tax, Social Security, and Medicare tax. So it truly is now you're taking your first $7,500 worth of daycare expenses and making it truly pre-tax.
Nice.
So
that's a good one.
Yeah.
Of course, this would come out when we have 8 months left of daycare for our
I know
child, right? But it's all good. Everybody else can benefit.
Now, employees, and this affects more employers, but it's considered small businesses. But employees can deduct up to $12,500 in qualified overtime compensation, even if they don't itemize. So this is going to fall on to the employers. We're going to actually talk about this particular change in more detail. We're probably just going to do a podcast episode on that because the W-2 just got redrafted and there's some changes to it that I think are important. So this affects employers, business owners, it doesn't necessarily benefit them on a tax perspective, but it definitely changes their tax compliance. Let's put it that way. That's why we wanted to put it into this podcast episode. I'm going to finish with, so that's the overtime deduction. Now, the tip income deduction for workers. That's another thing that employers, to say they're burdened with it might be a little harsh, but employers now have to properly report qualified tip income. So taxpayers in customarily tipped occupations may deduct up to $25,000 of cash tips per year from their income. And it actually applies to gig workers also. Remember, we have a whole episode on gig workers.
Right. So even like the Uber drivers.
For the employer, yes, we are going to do more content on this, but with the employer, you have to determine, is someone customarily tipped occupation? The IRS is going to provide guidance. And if the business is an SSTB, and not again, specialized service trader business, then what we think right now is that those tips are still going to be taxable.
And
So
this is something obviously the IRS is going to expand on, provide the guidance. Right now, it's just kind of, it's there. It's out there, right?
Why we put it in this podcast episode, if you're an employer with W-2s, just be talking to your payroll service company, your tax professional, about the new tip rules and the overtime rules. And then let's celebrate my top 4. Right? Section 199A, aka qualified business income deduction, bonus depreciation back to 100%, opportunity zone funds, and the SALT tax deduction / PTE workaround, ultimately saying your state income tax with the proper planning will be deductible on your federal tax return for these business owners.
Awesome. And Chris, I know you came up with this list probably while you were, either in the shower, I can't say using shampoo, drawing it in the shower tiles, your top 10, or sitting there reading your periodicals, magazines is what we older folks call those things that are printed, next to the toilet in the restrooms, reading up on this stuff. But as you mentioned, I'm glad you went through this list. I know we talk about them kind of casually, just in conversations, me and you, and with clients and community members, and a lot of it, right? There's direction with it, but there's nothing concrete with a lot of this from the IRS, right? We're taking this 1,000-page full document that is extremely overwhelming to anybody with a pulse. If you were to look at it as one thing, we're taking out these little bite-sized chunks of it, digesting it, talking about it as it is. And who knows, here we are talking about this stuff here in September. It's likely going to change a little bit. It's going to get tweaked, right?
Yeah, I mean, I don't think the tax laws are going to change, but what happens is just because a law changes, right? Now it's up to the IRS to interpret it and how it's going to be ruled on, how it's going to be enforced. And that's where we'll see what happens. We have some guesses right now, but yeah, we're going to see how it goes.
Yeah. So we're here. If anybody has any questions, the best we can. I mean, again, we don't have, I should say we, Chris. I mean, obviously, I don't have many answers when it comes to, hell, I said depreciation recapture, and I thought Chris was about to start lighting candles and fireworks for me. I had a proud friend moment there. But yeah, you know what? We're going to make a reel out of this, and I'm just going to play it. It's going to be your ringtone when I call now. I'm just going to say
that's
that.
Cool.
It'd be fun. But yeah, I mean, probably, and Chris, tell me if I'm wrong, right? I think it's the business owners, taxpayers as a whole. Things like this are great just for you to be aware of them, right? And I think too, if your tax professional probably is keeping in tune with the stuff, is probably going to relay information to you as well it comes. But again, the tax planning part of it, just you knowing what's on the horizon is a huge benefit just for you to be aware of things, right? Because who knows, some of these may change the way that you are growing and expanding your business. Who knows? It may direct things in certain ways, pro or con, but I look forward to these episodes we got coming up. Chris, I know you mentioned some really good topics, personally interested, myself. So I imagine some others are as well.
Absolutely. As IRS guidance comes out, we are going to keep you updated. My best tax advice to you right now, it's completely free advice. People pay a lot of money for our advice in the private CPA firm, to be honest with you. Just subscribe to the Teaching Tax Flow YouTube channel. I know it sounds like self-promotion, but trust me, it is. We put a lot of content out there. When new laws come out, when new guidance comes out, we make a video and share it. So
absolutely. And I'll put the link too in the show notes for this as well, directly to an OB3. So that's that One Big Beautiful Bill Act. We have a playlist that we hit on a couple of these topics a little bit more in depth too. So I'll drop the link in here. It'll take you straight to it. I'll also put the link in there. Really easy. Click on it once and you can subscribe to the channel. You don't got to go click, give your social number, sell away your first child unless you want to. That's a whole nother conversation. We won't force you to do that. But check it out. As Chris mentioned, great content on there, tons of it, 550 some odd videos we have on this thing that you can search by topic. So take advantage of it. Free advice. Won't cost you anything but a couple clicks. And we'll see everybody back here again next week on the Teaching Tax Flow podcast. Same day of the week, different date, completely different topic. Have a great week, everybody.
The content provided is for educational purposes only. We encourage you to seek personalized investment advice from your financial professional. For all tax and legal advice, please consult your CPA or attorney. Investment advisory services are offered through Cabin Advisors, a registered investment advisor. Securities are offered through Cabin Securities, a registered broker-dealer. The content of this podcast does not constitute an offer of securities. Offerings can only be made through an offering memorandum, and you should carefully examine the risk factors and other information contained in the memorandum.